terms half year. So that is the assumption. And in the examination also, if I just say that there's a coupon payment of so much, if it doesn't say that it is been done half yearly, then you have to take it as half year. That is in default, because most of the bonds are paid coupons half year. That is how it happens. So therefore, what you have to do is you have to just draw a line and to show that the particular point. So it's like this. Now say 2 years and 10 months means it is short of 2 months for 3 years. I mean, 2 years and 10 months means that time period is short of 2 months to 3 years. So therefore, you can draw a line which represents 3 years. So then you can say this is the first year, second year, third. Now 3 years, 1, 2, then Q. The point here. So this is the point where the sale is made. You can say point of sale. Now this particular time period is 12 months. We can say this is 6 months. Then it should be here. 6 months. Then this is 3 months, and 2 months is somewhere here. So we can say 2 months. The rest of the period would be 4 months. Right. Now this is how the things come. Then this is another 6 month period. So when you put 6 months period, you can put 6 months period number. Now this is this 6 months period. This is number 1. 2. Then you have 3, 4, 5, 6. Now there are, if you take half year periods or 6 month periods, you will get altogether 6 months period, right? But if you take this particular one, now the last coupon payment date was this. At this point, the last coupon was paid. Next coupon will be paid here. You can say this is the next coupon date. Next one. Next coupon date. Now, when you say the next coupon date, last coupon date was this, and the sale point of sale is this. Now, since this is the point of sale, until this time, the bond was with the earlier person, the seller. Bond was with the seller until this time, this particular date. But during that period, interest was accrued. That is what we call the accrued interest. That is what we call the accrued interest. So therefore, we have to see the time period on which the interest was accrued. Now, in this particular case, the time period is 2 months. If you take the total half year period, that is 6 months. So if you take 2 months as a portion of half year period, it is 1/3. 2/6 is 1/3, no? So that particular period is 1/3 of a half year period. Now, if you can get the half year interest, half year period interest, and 1/3 of that would be the accrued interest, right? I think that's understood, no? Right. Now the coupon payment, say coupon payment is 6%. Say I'm just getting a certain examples here. Coupon payment. Payment at 6% per annum, and we will assume one value, face value as 100,000. 100,000. Since the bond value is 100,000, and we have assumed the ITM also. Say ITM is 10%. ITM is 10%, right? You know what is ITM, no? Yield to maturity. Yield to maturity. So ITM is 10%. Then we have to calculate. Now, first thing what we can do is we can calculate the accrued interest. Now, as it is, what is the accrued interest for this point? As it is, you can just give it in memory. You can calculate. I think now since it is 100,000 per annum, coupon is 6,000. Is it? Since it is 6% coupon, and half year it is 3,000. Half year is 3,000, and 1/3 of that half year interest rate would be the accrued interest. So it is 1,000. Accrued interest is 1,000. That is how we can get it. Okay. Then now there is a very easy calculation. Accrued interest equals to half year interest into 1/6. This is how we calculate it. Because the whole period is 6 months. Accrued interest was accrued for a period of 2 months. So therefore, 2 months over 6 months is the portion. So that portion is 1/3. That has to be multiplied with the half yearly interest. Half yearly interest is so much. That is 6,000. Sorry, 3,000 into 1/3. Then it is 1,000. It is 1,000. This is the accrued coupon interest. Now the story is now this is the very minute part of the story. Now the other things are so much comprehensive. Now say, this is the point of say. Now only issue is now to take this point and this point, the distance between these two, that could be 4 months. But from here onwards, all the coupon payment dates will be like this, and payments are made similar intervals. Similar intervals. Since those are similar intervals, we are in a position to do the calculation for these periods. There will be 5-6 month period. 5-6 month period. So what we now do is we will try to see the value of the bond at this point. Value of the bond at this point. So that's a future point. It is 4 months away from now. 4 months to the future from now. So at the 4 months period, now this is the particular point. So at this point, we try to see the value of the bond. In order to get the value of the bond, we have to just calculate these cash flows, and we have to get the present value. This has to be total. Now we start with this. If you get this, what is the flow? 3000. That is the interest cash flow, 3000. So we can say, now what we do is calculate in the value of the bond. Calculate the value of the bond at next coupon date. Next coupon date. This is the next coupon date. Now to calculate the value of the bond at the next coupon date, what we do? We can just say the price is P. P equals 3000 divided by, what is the YTM? 10%. Now YTM is 10%, that is for 1 year. So then we are just referring to half yearly periods. So therefore the YTM for a half yearly period is 5%. 5%. Then we can say 1 plus 0.05. Because from here there is only one period. If you take this, this would be 3000 divided by 1 plus 0.05 to the power 2. Because it is away, it is from here 2 periods away. If you take this 3 periods away, then you say 3000 divided by 1 plus 0.05 to the power 3. Then if you take the other one, that would be 3000 divided by 1 plus 0.05 to the power 4. And the last cash flow would be not only 3000, maturity proceeds also will come. Maturity proceeds also will come. Maturity proceeds will be 100,000, since we have already assumed that it is 100,000. So then here it will be 103,000 divided by 1 plus 0.05 to the power 5. Is that the value? Is that the bond's value? I am asking. At this point, on the next coupon date, that's the value or not? You have to give an answer, yes or no. What do you say? You say no. Why it is? Why do you say no? Yeah. Now on this particular date also there will be a coupon payment. So that coupon payment also to be taken into that. But that adds to the value of the bond. So therefore we can put 3000. 3000 also. But in a rational way, this 3000 should be added here. I think if you add 3000 here, you might be misled. Rather than doing this, what we can do is we can add 3000 first. I think that would be the better way. Yeah? Otherwise, people get misled by that. Any question on this? Now it's clear, no? Right. Well, I have seen several students find it difficult to understand this accrued interest concept and the calculation of the bond price with that. So there can be several awkward situations you have to face when you do it. Now, I think this is clear enough. No? Clear enough. So if you do the calculation, you can arrive at the value. But don't worry about this calculation, because if you use this type of calculator or a normal scientific calculator, it is very easy. Otherwise, you have to just do the calculation one by one. So that's a very laborious operation. So what you need either type of financial calculator or a scientific calculator. Those are allowed. Allowed for the examination. Allowed for the examination. So we can just do the calculation. And if you have a scientific calculator, I can just show it how to do it also if you want. Because you can do repeated calculations with the calculator. Otherwise, what you can do is you just do the calculation for the first one and write it. Again, do the calculation for the other one. So you don't do that. It will take so much of time. But you can't, if you do that way, you may not be able to complete your things in the time. Really. 3,000 plus 3,000 divided by 1.05 plus 3,000 divided by 1.05 plus, right? You can do the repeated calculations. Even with the scientific calculator, you can do the same. This is the financial. This is what you call Texas instruments. No, you can. Provided that you know how to operate. Even though you have a calculator, if you don't know how to operate it, then it's a problem now. Therefore, I don't feel anything against that. But you can use any type of calculator. I mean, other than the programmable. The programmable one, the story is different. Oh, any other type of issue? So even for CFA and other FRM examinations, this calculator, we should not ban that type of things. So this is not a big ban. And it's know how to operate it. No, right. Then we will do the calculation, and I am just doing it. Now say 3,000 plus 3,000 divided by 1.05 comes as 5,000. I will do the repeated calculation. Then 3,000 divided by 1.05 to the power 2. Then you get 3,000 divided by 1.05 to the power 3. Then you get 3,000 divided by 1.05 to the power 4. And the last one would be 103,000 divided by 1.05 to the power 5. You get the answer as 94,874. 94,874 inches. 94. Yeah.
You also have plan to
yeah. So anyway, now what shall I do? So if I do not go to the board, is it okay or?
no, to get it
okay.
Otherwise, if you come here, they may get to cover. Normally, the thing that I am not like that.
Right. Okay. No, I also just thought about it because I thought that these particular things are available. I mean, now when I go to the board, is it?
Now it's okay, but it's okay.
Yeah, but online students that problem. Right. Okay.
And we also have to
Yeah, later. No, right. Okay. But I think these things are clear, no, on the board. Right, then I will write down the things there. Then that will, the people can really use it. I will put the answer there. Right. Now this is the price of the bond at the next coupon date. At the next coupon date. Now what happens is, even though we put it that way, now what we need is to get the price at the point of sale. So this is not the price we need to calculate. We need to calculate the price at this point of sale. So how are we going to get it? And we have to calculate the price at this point. So we have to get the present value of this price. Present value of this price. So in order to calculate the present value of the price, what we need to do is we need to discount this for this particular period at the particular discount rate. Now, what is the discount rate here? What is the discount rate here? Yeah, 10% is for a half yearly or yearly period is 10%. For a half yearly period, it's 5%. It's 5%. Is that okay? Right. Then, when you do that, just tell me how we can discount. Now, this has to be discounted. This value has to be discounted and divide by what? 1 plus 0.05 to the power 1. So then that power we can find by looking at the portion of the half year period. What is the portion of half year period we have to think about? See the portion. 2/3, not 1/3. It is 2/3. You have an issue. It is 2/3, right? For at least 4 months. You take 6 months. This is the whole half year period. If you take 4 months, it is 2/3 of the 6 months period. 2/3 of the 6 months period. So then what we can do? We can get this way. The price is equal to 94,874 times 15 divided by 1.05 to the power 2. Now you can justify why you have put 2/3 there, because this is the portion of the period we are referring to. We have already referred the half year periods. Since it is half year periods, we have taken the half year periods portion there. If you have taken annual periods, then you have to take it as a portion of an annual period. If you take it as a portion of an annual period, what is the portion? 1 quarter. 4 months is 1 quarter. To take it by annual terms, it's a 1/4 of an annual period. 1/4 of annual period. Sorry. 1/3 of annual. 4 months now. There are 3 4 months periods in annual period. 1 into 3 is 12. Right, okay. Right, do the calculation. And do you have any calculation with you? Now, this calculation has to be done. So put 94,874. 94,874 times 15 divided by 1.05 to the power 2/3. Now, how are we going to calculate it? Now, you can put yx here, y to the power x. Then you open a bracket and say 2 divided by 3 and close the bracket and press and you get the value 91,837 and 8. So I just advised everyone to do the things while I deliver the lecture. All of you should do that. Then it's very easy for you to understand. Otherwise, you will get sometimes distracted from this. And later on, you might find what is it. So then, my advice is to just follow it with me. Then you also do the things while I am doing it. 91,837.84. Right. Now, this is what we call the price of the bond. The price of the bond. And I think I just told you about dirty price, clean price, and all sort of things. Now, this is what you call the clean price. Clean price. Clean price of this bond is 91,807. What do you mean by dirty? Dirty price is the clean price plus the accruing. Now, just think about the justification of having this accrued interest calculated. So, how do you justify that in a market? Because we are just referring to a market now. In terms of a market now, what the seller really lose his entitled interest. That is why the seller needs to have that as a compensation. Do you agree with me? Do you agree with me? In markets, sometimes the accrued interest is not being paid. So that all depends on the agreement between the buyer and the seller. But in normal circumstances, the accrued interest is paid. Now, if you go through these trade summaries in the treasury, you find that. Now, some of the treasury bond issues, they said the accrued interest is so much. They have given the accrued interest also. For a bond, which has to be sold on a date, it is not a coupon date. In the middle of a coupon period, if a bond is sold, they just give the accrued interest also. Now, there can be an exercise for you. Or exercise or even an examination question. Now, I will just quote from that type of information sheet and show you the bond. And for the particular one, they have given the accrued interest. You have to show that accrued interest is to the bank. It is not unfair. You can do it. And it's a type of test. Whether they have done a correct calculation of accrued interest. That's good for you. So even for institutions, your institution can show that you have found that. If something went wrong in their calculation, you are in a position to find it. Right, okay. I think this is now clear enough. And the terms are very important, right? You need to look at these terms. Clean price, dirty price, and such type of things. Yeah. Right, that's a good question. So then what we need to do is, we need to but only issue is this. Now, if you do that, for this period only you have to have that particular thing, but others you have to do the other thing. from here, what happens then? Because the thing is now, I think it is like this. So this is a good question, but you can see the issue. Now, when you calculate the price at this point, what happens is you have to get the cash flows. All the cash flows and those has to be present value. Now, if you take this point, and this is the first cash flow we will have. So that cash flow is 3,000. Is it? So how do you do that? 3,000 divided by 1.05 to the power 2 over 3. That is how it has to be. Now, if you go to the next one, how can it be present value? 3,000 divided by, tell me, 1.05 to the power what? To the power 1 plus 2 over 3. What do you mean by 1 plus 2 over 3? That is 5 over 3. 5 over 3. So that way we can do. So then the next one, this one, it would be 1 plus, not 1, 2 plus 2 over 3. Now when you say 2 plus 2 over 3, what is that? 8 over 3. So likewise you can do. If you do the things that way, you will get the same answer. So that's a good way of doing it. And it's another way. Okay. There's nothing wrong. Nothing wrong. And I will show you another way. You can do it for any number of days. Here you have 2/3. Now sometimes you can have this number of days as a not a quotient. It's not a calculatable number like. Okay. Also we should be in a position to do it. I will show you how to do it. Right? There's another way of doing it. Through the we call it continuous compound. You use the continuous compounding method, then you can do it for any number of days. There's no restriction on that. I will show that also now. I think that is another complicated issue students should understand. And this type of class is very much necessary for that explanations. Otherwise, it's very difficult for me to explain these things through the online class. But the facial expressions, the body language, and all those things will not come there. That is the issue. Anyway, I think this is understood. So then those things, the words, the dirty price, clean price, accrued. These are the 3 words which you need to understand. And there's another thing which you need to get. There are standards of interest calculations. Now sometimes we call it. Now when you talk in terms of interest calculations, there's a thing called actual 365. Then actual standard, or likewise there are different types of interest calculation. So that means the number of days per year is given as a standard. Sometimes in different calculations, they assume 360 days. That's what you call the 360 standard. We call it 360 standard. Some cases is taken as 365, the other standard, or actual. Actual means if the year is a leap year, we have to apply 366. The year is a normal year, we have to apply 365. These are the conventions of the record. It's also useful to understand. Right, also. Right, anyway, now any question on this accrued interest calculation? Now say this can be different things. I mean, I have given it as the remaining maturity as 2 years and 10 months. It can be some other thing, 3 years and say 5 months. That is also a possibility, no? 3 years and 5 months. So there, what is the how you can get the assuming that it's also a half yearly payment. Just tell me, 3 years and 5 months remaining maturity. 3 years and 5 months. So then, what I am asking is, entitled accrued interest is for how many? I mean, what is the period of accrued interest for that? Now I am asking the accrued interest. Now my example is remaining maturity is 3 years and 5 months. Yes, and 5 months. So it should be, I mean, the accrued interest should be less than 6 months. Accrued interest. So my example is my example, the remaining maturity is 3 years and 5 months. And it should not be a coupon date. No. So now you have to look at what is the nearest coupon date, nearest last one, and nearest next one. Tell me what is the nearest last coupon date? How many time period away from that particular? Only 1 month. 1 month. Another 5 months to be born. So then for the next coupon date, there's 5 months. What is the period of accruing? What is the period of accruing? 1 month. It's a very simple thing. Now, what I told was, in maturity, 3 years and 5 months. So that means the one was sold on a day, it is 1 month away from the last one. That you agree? For another 5 months gone. Because at the end, it's sure now there's another coupon payment. So therefore, another 5 months is there to get the next coupon. But the last coupon was 1 month away from coupon. So then the 1 month is the accrued interest. So that interest is entitled to the who? The seller. That is a seller's entitlement. So likewise, you can just calculate. Now, may not be sometimes can be given in months, can be given in days. If it is given in days, what will happen is you have to calculate it in the annual basis. Now, for example, say the accrued interest is for say 41 days. Just giving you example, 41 days. How do you do it? It is for 41 days. How do you get interest calculated? 41 divided by 365. So they are the convention terms. Then you have to check whether the particular year is a leap year or a normal. And the other thing is whether any convention of 360-day convention. Then you have to go back to 360. No. No, it's okay. You have to wait some. No, I'm just referring to if you go by days, number of days. Right? No, we are not going to now, I mean, half yearly things, we can do this. Now I'm just referring to the continuous compound. Doing continuous compounding cases, you can just go. I will do another example. Yes, here we have to do it. But we are not going to do the continuous compounding here. Continuous compounding is a different case. I will go to that. Because I just explained this through the online class, but I don't know whether people have got it. That continuous compounding thing, what it is. Anyway, I will just do it now. Do you have anything to clarify here? Anything else to clarify here? No. I think my lecturing is, if I do this way, it should be okay, no? Is that? Yeah. Right. Right. Now, when you do this continuous compounding, I will just give an example, right? Now, say for example, if you pay interest quarterly, right? I will say my quarterly payment is 3%, right? My quarterly payment of interest is 3%. So then, in simple terms, what is the annual rate? If I pay quarterly 3%, what is the annual rate? In simple terms. Don't go for effective rate or whatever. Just say it in simple terms. Annual rate is what? 12%. Annual rate is 12%, if that is the case. But that is in simple terms. That is not very accurate. If you want to put it accurate terms, how do you do that? 1 plus. Now, 3%, how do you put it in decimal form? 0.03. 1 plus 0.03 to the power 4. Now we can check how it goes away from 12. Shall we look at 1.03 to the power 4. 1.03 to the power 4. There you get 1.1255. Now when you get the effective rate, you have to deduct 1. Then you get 0.1255. That means 12.55. That is the accurate effective annual rate. 12.55. Now there we went to a quarterly thing. Now if you go for a monthly thing, say monthly interest is 2%. Tell me the annual rate. If it is in simple terms, annual rate would be 24%, is it? We just multiply it with 12. Since there are 12 months for 1 year. That is why we multiply 2% with 12. Then you get 24. So that is the just a nominal thing. But if you want to get the effective rate, what are you going to do? 1.02 to the power 12. 1.02 to the power 12. Now, what is the answer there? You get 1.02 to the power 12. That is 26.82, is it? Now you see the difference. If you do the simple calculation, it is only 24. Whereas if you do the effective calculation, it would be 26.8. So that is what we need to understand. Right, now I started with the quarterly thing. Now I went to monthly. Then we can say weekly. I will tell. Weekly rate is 1%. If the weekly rate is 1%, tell me the annual rate. In simple terms, it is 1% into 52. But if you do the effective annual calculations, then what do you get? Calculate and tell me. 1.01 to the power 52. There are 52 weeks per 1 year. Then you get 1.6776. 77. 67.77 is the annual effective rate. Annual effective rate is that. Right. Anyway, weekly. Then we go to daily. Assume a year of 365 days. Daily rate is 0.5%. Daily rate is 0.5%. So how can you calculate the annual rate? If the daily rate is 0.05. 0.05, not 0.5, 0.05. 0.05. There are 365 days per year. Now I will show it this way. Quarterly rate. I started 3%. 3%. Annual effective. 1 plus 0.03 to the power 12 minus 1. Sorry, not 12. Here, 4. Since it is quarter, right? Quarter rate 3%. Annual effective is 1.03 to the power 4 minus 1. Monthly rate. Say 1%. Annual effective is 1.01 to the power 12 minus 1. Then I go to a weekly. Weekly rate I got as 0.5. Annual effective is 1.005. Now you have to be clear about this decimal conversion. Now sometimes you get the things in percentage form, but in calculations it has to be converted to decimal form. Now if you say 25%, in decimal form it is 0.25. If you say 0.5%, in decimal form it is 0.005. That is why I put 0.005 to the power of 1. Week, so 52. Then week. Then daily. Say daily rate is 0.05. Then annual rate 1.0002 zeros. To the power 365. Is that clear? Then now daily. Now how can we suppress it further? Hourly. I want to show you the mean of continuous compounding. Hourly. Say hourly rate is 0.0001. There are 1, 2, 3 zeros. So how can we put it there? Annual effective rate 1 point. You have to add 2 zeros in front, right? Then it will be 1, 0, 0, 0, 0, 0. To the power what? To the power what? Yeah, 365 into 24. Now you can see, now the number of hour has gone up when the time is very short. Shorter the time, smaller time, the power goes up. Then hour, then say minute. Rate per minute. Rate per minute. So if it is a rate per minute, I can say 0.000001. A minute. So how many minutes? It's So this has to be multiplied with 60. Tell me the number. 1.568. What is the value? 525,600. If I put it for 8 per second, we will put 0, 0, 0. How many zeros here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 zeros. Now there will be 12 zeros here. To the power what? 525, 600 into 60. What is that value? 31,536,000. Right. Minus 1. Right. Now the meaning of continuous compounding is what? Now we have gone down to a second. And it's a very, very small time period. But we can get the time period the nanoseconds. Nanosecond is 1 millionth of a second. Nanosecond is that. Even 1 millionth to 1 billionth of a second. Right? But continuous compound. Tell me the time. It is not even 1 trillionth of a second. It's smaller than that. But it is not zero. But it is very, very close to very, very close. That is the concept of continuous. But this calculation will not be very important. So then the particular power will become infinity. Power will become infinity. Now we call it an exponential function. Exponential function. Have you seen a particular thing called e to the power something? You can just look at the calculator and do e to the power x, ex. That is what we call e, exponential. Now the exponential's behavior is when you have high power, you get exponential numbers, and that will end up in infinity. It never ends. That is why we call it infinity. There's a single song. That is met in the ending. So now I will give you a simple formula to get this in continuous compound. Say for example, I want to continuously compound interest for say 3 years. Per annum rate is sorry. But no, we have to get the per annum rate. Then only we can do that. E to the power, sorry, e to the power n. N is the number of years. Now this is the compounded formula. Compound N is the number of years. R is the per annum. Per annum. Right. I will now go to the next lesson. I think that lesson we have to apply this compounded interest equations. Right. Duration measure. Now this duration measure is a very important measure with regard to the bond valuations and bond calculations, where the bond is a, we call it a fixed income instrument. Fixed income instrument. Bond is called a fixed income instrument. When you say a fixed income instrument, it gives a certain return. It gives a certain return. That return is known as YTM, yield to maturity. Not only that, most of the bonds pay coupons. Most of the bonds pay coupons. Right? Now, when a bond is not paid a coupon, we call it a zero coupon bond. There are two types of bonds. Some bonds pay coupons, either half yearly or annually. Some bonds do not pay coupons. Such bonds are called zero coupon bonds. Zero coupon bonds. But most of the time, when we talk in terms of a duration, now normally in colloquial terms or in literal terms, duration is the tenor, the period of maturity or whatever. That is what you mean by duration. But this duration measure is not that. It is something different. It is something different. Now I will just explain that this way. Now when I say, if it is, say, if you do a certain type of investment, that investment will give you a payback. Now, I get an example from a bond. A person has invested on a bond and he has to pay that price, the purchase price. And what will he receive? What would he receive now? He will receive coupons, coupon payments. Next coupon date, he would receive a coupon payment. Next coupon date, another coupon payment. On the last coupon date, he would receive coupon payment plus the maturity proceeds. Those are the cash flows he would receive. Now, the concept of duration means the period at which what he has invested, now his investment is paid back. That is the period we refer to as duration. In other words, if a person has invested something on a bond, if he receive the whole investment, present value of whole investment in a particular date, the time period for that date is called the duration. Right? So that is the physical explanation on duration. So then I am asking you a question. There's a bond. It is a zero coupon bond, and it will mature in another 3 years. Right? What is its duration? Duration is measured in years, right? I'm just referring to a bond which is a zero coupon bond, which will not pay coupons, and it's a 3-year maturity bond. What is its duration? 3 years. Very clear. 3 years. Another bond. There's another bond which pays half-yearly coupons at say 8%, and the bond maturity is 5 years. What is its duration? Yeah, very good. It is less than 5 years. It is less than 5 years. Why do we say that? Because we can guess, since the coupons are paid, to receive his total investment, it would not take 5 years. Before 5 years, I mean, it is very close to 5 years, but before 5 years, he would receive the whole investment he just invested. Yeah. Is that clear? Now, for example, say it is 100,000 bond, right? Even though it is 100,000, he normally doesn't pay 100,000. He would pay 95,000 and by just the bond, since it is 5 years, right? 95, say 95. Then he has to receive 95,000. Now, would he wait till 5 years to receive that 95,000? No. So that he would. But if you take the coupons, you can't say that. Now, say, if it is paid 8% coupon, that means the half year he will get only 4,000. So since it is 5 years, how many half year we get? 10 periods are. So if you get the 10 periods, even it is 40,000 only. But the thing receives, he will receive the last maturity percent. From that only he receives the whole thing. But he won't theoretical. He won't wait till 5 years. Because if he waits 5 years, he will receive more than what he has invested. That's all. Yes. So they are, but only thing is now, this is a theoretical point. Don't select so much. It's a theoretical point. So what you can do is you can't calculate the things on this basis. You can just say it is less than 5 years. That's only you can say. But even though it is less than 5 years, it is not very much less than 5 years. It is close to 5 years. Close to 5 years. Now that closeness depends on the amount of coupon payment and the implementation. Those things will decide the exact time. What my point? The exact time is decided through the coupon payment and the yield to maturity. If the coupon payment is higher, the period can be shorter, is it? Because he would receive the things quickly than 5 years. Say, for example, I will give you two bonds. Others are same, but coupon payments are different. So one bond pays 10% coupon, other bond pays 6% coupon. But bond has a lower duration. The bond with 10% coupon will have a lower duration. You agree with me? Because he would receive money quickly. Now, instead of 6,000, the person will receive 10,000 per annum. What values? So therefore, that happens in that manner. So this is how the duration is explained in physical terms. In physical terms, but it's a very real analytical method. Now this analysis is we normally do for interest rate sensitivity calculations. What do you mean by interest rate sensitivity? Now the bond values and all basically depends on market interest. I think up to now what we have learned, I think you can really guess that particular thing. There is a phenomenon where you have to be very careful about. Market interest rates decide the bond valuations. Now I am just asking a very simple question. Now, say for your institutions, you have bond portfolios, big portfolios with trillions of value or billions of value. Now, as a investor or a treasury manager, what do you prefer? Having lower interest rate regime or higher interest rate regime? As a manager for treasury bond portfolio, what do you prefer? Having increasing interest rate scenarios or decreasing interest rate scenarios? Don't think about other things. I'm just asking the point of view of a treasury portfolio manager, treasury bond portfolio manager. You have a very high valued portfolio, billions of money, billions of money. Yes, what do you prefer? Having a higher interest rate regime or lower interest rate regime? Higher interest rate means you will expect interest rates are going higher and higher daily. That is one we pay. Otherwise, interest rates are going down every day. Like, which one you prefer? You prefer higher interest rates. That's the thing. Anyway, you just think about it clearly, and it's a critical thing. No? You need to have a very clear thinking on that. Do you think that bond value will increase with the higher interest rates? What do you think? Or the other way? Interest rates are going up. What could happen to the bond value? This is a very particular type of a question, right? This is a very, famous question. People, most of the time, they become wrong. Pardon? Yeah, it will reduce. It will reduce. What does that mean? Now, say you can purchase a bond at a lower price when interest rates are high. So the meaning is that then the bond value has come down. So in that case, if the interest market interest rates are going down, bond values will come down. That is what I want to show you. So as a portfolio manager, you don't like to have high interest regime because your bond portfolio will come down in value and it will be registered as a book loss. Drastic situation. If you have a bond portfolio of billions, say, even a small reduction in interest, small increase in interest rates will have a drastic drop in your value, the bond portfolio. Now the duration is a measure for that. Duration can measure that type of a drop. That is the importance of duration. Measure called duration. And we call it Macaulay duration because the person called Macaulay, the person who invented this thing. So that is what you call the duration measure. duration measure gives you a guidance to see that for a particular level of interest rate change, what could be the value drop or value increase in your portfolio. If you know the portfolio duration, you can better understand. That is the importance of calculating this duration. Yeah.
So it is about,
Yeah. No. That's a good question. Face value is same. No, I am not referring to the face value. Now here also we talked about 100,000 face value one now. Now any issue we can say it's 100,000 face value. It's okay. 95,000. Yeah, 95,000. That is the value. So that value can depend. It depends on the YT, into maturity, and the open field. Throughout the 5 years, the base value remains same, but the value can be different.
Selling.
Yeah, issue. If you want to release in the book, no issue there. But we can't say the value. That's why now for all these one portfolios, we mark to market. There's a thing called marking to market. If you talk with your treasury guys, they will say they have to mark it to market. Mark to market means now there are portfolios called trading. Now those portfolios, you keep your bonds, the intention of selling, or with the intention of buying something also. Such portfolios are called trading portfolio. Now for trading, now that is what I am referring to, a portfolio manager, treasury portfolio manager. He has to deal with bond purchases and sales. But he should understand. He should manipulate his portfolio in order to get the profit. Now, in the scenario where interest rates are going up, his portfolio value will come down. His portfolio value will come down. Even though you say that face value is same, but you measure the bond value at a particular time, the value depends on the YT at that time. Now, for example, today I have purchased a bond. As per today's interest rates, its value is say 95,000. Right? But tomorrow or day after, interest rates are gone up. Today's YTM is say 10%. But another 2 to 3 days time, it has gone up to 11%. There's a 1% increase in the YTM. Now, would you expect the same value for the bond? No. It would be less than 95,000. Now, this duration method gives us to calculate that value for a particular interest rate. That is the importance of duration measure. For portfolio managers, it is a very useful measure. But the portfolio manager can exactly see what could be the impact on his portfolio that interest rate change. That is the reality of now, that measure actually, even though it was found in 1950s, for a period of say 20 to 30 years, it was not touched even. Late 1980s only it has come into the active usage on it. Now it is even in international markets, it is in use. Have you heard about these Bloomberg terminals? private bank, commercial bank. Now, you go to the question, you are actually ask them, how do they deal with their fixed income? They might come up with the answer, they Bloomberg term. Even in meeting rooms, they have Bloomberg term. Okay. Now, your question also will have a Bloomberg term. The Bloomberg term, and all these things are there. You can just picture things and look at the duration. And you can have each market, what is the duration of bonds they sell. That type of information is available in the Bloomberg. That is how you can make use of these things in practical sense. Right. Fun? Yeah. Now here the Bloomberg has so much of information. Now it has information from all over the world, all the markets, fixed income markets, derivative markets, and equity markets. All market information is available in the Bloomberg. And not only that, they have a platform to do the trading. The platform is there. And the dealers have their own passwords and they can do the dealings. The Bloomberg. For example, now if I want to purchase $3 million from a particular market, so I can do it through the Bloomberg, provided I have the passwords and all that. Most of the banks is available. Bloomberg. Got them? Yes. Now, if you go to Bank of Ceylon Treasury, you can see all the Bloomberg. You can talk to and ask. I can remember now. Actually, I joined Bank of Ceylon in 1986. That time, the Bank of Ceylon was the only bank they had the Bloomberg that time. But most of the banks had at that time the Reuters. Later on, the Reuters was out of date. Even the Bank of Ceylon had the Reuters things those days. Later on, they converted to. Now, I think the Bloomberg is very much specialized in fixed income rather than foreign exchange. But Reuters was very much famous on foreign exchange. But now the Bloomberg is equally famous everywhere. They have a particular website also. I think for your interest, you can just access the website and see what are their activities and all. That's very good for you. And they have a bigger magazine. Bloomberg markets. That's amazing. I had the subscription at that time. I went from Bank of Ceylon about the commodity. And keep this box. Joint Bank of Ceylon. 80. Right now, that is how the duration is so important. Right now, here I just want to show you the relationship of yield and price of a bond. Now, yield is taken along the x-axis, price is taken along the y-axis, the vertical axis. The other one is along the horizontal axis. Now, this curve represents the behavior Now here it says, when the yield goes down, price goes up. That's what we now discussed. For a bond, if the market yield goes up, the price goes down. That is what it shows here. And I have just shown you some change in the interest rate, delta Y. I have just mentioned it as delta Y. Yeah. If the interest rate increases delta Y, what could happen to the price? Now, at this point, the price is this. At this point, the price has come down to this. Then there's a price change. For the delta Y price change, what is the, sorry, for the delta Y change of yield, what is the price change? Delta P. Delta P is the length of this delta P. Now, the earlier price is this, present price is this. So, the drop is this, is the drop. For a delta Y increase of the yield, there's a drop in price of delta P. Is that clear? Now, that is why the price yield curve is a declining curve. Declining curve. Now, this particular graph is price versus yield relationship of a fixed income security. This graph shows that. Now, the duration measure is a sensitivity measure. Now, duration shows the change in price for a change in yield. For this much of a change in yield, there will be this much of a change in price. That indication is given by the duration. Now, if you look at the relationship in the left-hand side, that is delta P over P. What do you mean by that? Delta P over P means the relative change in price. Earlier price is 100. There's a change in price of 2. Then what is the price change? 2%. 2 over 100. So this is the relative change in price. The left-hand side of this equation shows the relative change in price. And it is equal to the relative change in yield into duration. Relative change in the yield into duration. So duration is defined in that manner. Why it is taken as minus? Why it is taken as minus? Yes. Yes, I think we have already discussed the reasons now. Why we have taken it as minus? Because the relationship is an inverse relationship, because when the price goes up, value goes down. Or sorry, when the yield goes up, price goes down. So since that reverse relationship is there, we call it the minus relationship. That is why we put the minus there. And the other side, the right hand side, there's another relationship. It is the same relationship in an it is an I mean, this particular relationship is rearranged to see as that, because they are main item is D. No? D is equal to so much. D is equal to minus 1 over P into delta P by delta Y. What do you mean by delta P by delta Y? Delta Y is the change in yield. Delta P is the change in. You can see the left hand side of this slide, which shows the value of D. Value of D is equal to minus 1 over P into delta P by delta Y. And where P is the price of the bond, D is the duration of the bond, delta P is the change in price of the bond in relation to the yield change of delta Y. Because it is natural. Because if there's an yield change, invariably there's a price change also. If the yield change is positive, that means it is an increase in change. What will happen to the price? Price will go down. If the yield change is negative, it is going down, price will go up. So make sure that you have that mindset. Everywhere you have to look at the bonds and all in this manner. This is a very important point to note with regard to the bond portfolio. Right, now we will see how we can do the calculations for this. Consider a 3-year 10% coupon bond with a face value of $100. Suppose that the yield of the bond is 12% per annum with continuous compounding. Now the continuous compounding has come into the scene. Right. The calculation of duration is given here. Just look at it. Now, rather than going through the present values in a normal way, normal compounding way, here we go through the continuous compounding method. Now the time is given in years. Now this is a half yearly coupon payment bond. Time, this is the first half year period, so therefore we put it as 0.5 year, 1 year, 1.5, 2, 2.5, 3 and 3. 3 is the number of years of the, or even the bond's tenor. Cash flows, since the coupon payment is 10%, half yearly cash flow is 5. Since it is $100 bond, therefore $5 will be received as the coupon for each half year. Now the present value is taken as 4.709. Now how do you calculate the present value? What is the yield to maturity? %. 12% means for half year it is 6%. Yield to maturity is 6% for half year. Then do the calculations in the normal basis and see whether the things are correct. Now how do you get the present value? 5 divided by 1.06. Just see whether you get the answer. 5 divided by 1.06. You know why we have done it? Because YTM is per annum it is 12, half year it is 6%. So decimal form it is 0.06, 1.06. 5 divided by 1.06. 4.716 or 717. That is the answer you get if you do it in normal compound. But here it has been done with continuous compound. Now we will see how we can do the continuous compound. So the formula is this. Now what is the cash flow? 5. 5 into, right? So I will put it as a present value is equal to cash flow CF into e to the power minus, because we are going to have the present values for future cash flows, then the interest has to be minus because it has been divided, minus n into n into. What do you mean by that? I will erase these things. Right. Now, this is the present value. So, in order to get the present value calculated, now what we need to do is we need to get the cash flow. Now, for the first half year period, the cash flow is 5, no? Is it? Cash flow is 5. 5 into e to the power minus, what is n? Number of years. Number of years. What is the number of years in that first cash flow? 0.5. 0.5. Number of years, not half years. 0.5. What is R? R is the yield to maturity. Right? N is the number of years. R is the yield to maturity. Yield to maturity is what? 12%. Is given, no? Given 0.12. Right. Now, how do we do the calculation? Now, just look at it. How do we do the calculation? Now, if you take this power 0.5 into 0.12, what is that? 0.5 into 0.1. What is the value there? 0.5 into 0.12. You get 0.06. Now we have to see how we can calculate e to the power minus 0.06 or minus. Now your calculator you can use for that. Just calculate e to the power minus 0.06. E to the power minus 0.06. E is there. Sit there or sit in yellow. If it is in yellow, you can press the button and then get it. Now, what we need to do is we need to find first e to the power minus 0.06. Have you got the answer? 0.9417. All of you can do that. The answer is 0.94176, but it has to be multiplied with 5 in order to get the percent value. That comes to 4.70882. And since we pick for 3 decimals, we can put it as 4.709. And the answer is correct. Now, I just want to show you that we get this answer as 4.7088. But since it is enough for you to have 3 decimals here, for the nearest 3 decimals, the answer would be 4.709. That comes as the answer. So if you go to the slideshow, right now that is how that we got 4.709. Now do the next calculation also and see whether this 4.435 is correct. There what you do, 5 into e to the power minus 1 into 0.12. Then there you have to calculate e to the power minus 0.12. E to the power minus 0.12. What is the answer you get for e to the power minus 0.12? Yes. 0.8869. All of you got it? 0.8869. And it has to be multiplied with 5. And you get 4.4346. Therefore, for 3 decimals, it is 4.435. That is correct. That comes as the answer. Then you can do the repeated calculation and see others are correct. Other present values are correct. The third one you get 1.5 as the time. So therefore, there you get 1.5 into 0.12. That is 0.18. You have to get minus 0.18 E. There you get 0.83527. And it has to be multiplied with 5. Then you get 4.176. 4.176. So likewise, you can just see. So I will go to the last one and then see at the third year, or here is 3. Cash flow would be 105, not 5, because maturity proceeds also would be received. That 105 into that e to the power 3 into 0.12. 3 into 0.12. That is 0.36, but it has to be minus 0.36 E. And that is 0.6977 multiplied with 105. 73.256. Now look at the chart. In the chart, you have 5 columns. The first column is the time column, time given in years. Second column is the cash flow column, cash flow given in dollars. Third column is the present value. Fourth column is the weight. I will say what it is. Then the next column is time into weight. Right. Now what you need to do is, since you have already done these present values, there you have the present value in the time number 0.5, 4.709 at 0.1 at 1, 4.435 at 1.5, 4.176 at 2, 3.933 at 2.5, 3.704 at 3, 73.256. Now what is the bonds price? What is the bonds price? Yes, it is available here. What is the bonds price? 94.213. That is the bonds price. Not the base value. I'm asking the price. 94.213. But these are the total of present value of cash. That comes to the price of the bond. That is 94.213. And I will explain you what do you mean by the weight. Now, just look at it. Now, weight is the, if you get the total of the price, this total is the price. Now, this cash flow as a percentage of this, or as a portion of this, that is what you call the weight. In other words, what you have to do is 4.709 to be divided by 94.213, and you should get 0.050. Just check and see whether it comes like that. 4.709 divided by 94.213. That comes to 0.0499. So that comes to 0.5. For 3 decimals, 0.050. Now our convention is, we have done it for 3 decimals. 3 decimals. And the next one, there what you do is 4.435 divided by 94.21. Yeah, you get 0.470. You can say 0.047. 0.047. Likewise, you can calculate each of these things. Last one, 73.256 divided by 94.213. There you get 0.778. Now the beauty of that is, if you add up all these things, it should come to 1. If it doesn't come to 1, something wrong somewhere. Now you refer to the third column. Third column is the multiplication of the first column and the fourth column. Time into weight. Time into weight. Time is 0.5 for the first in the first line. 0.5 into 0.05, that comes to 0.025. Then next column is next line is 1. Time is 1. 1 into 0.047, that is 0.047. 1.5 into 0.044, that comes to 0.066. Likewise, you have to multiply time and the weight. Multiply time and the weight. When you multiply the time and weight, you will get the fifth column. Fifth column is the time into weight column. And the total of that will give you the duration of this bond. The duration of this bond is 2.6533. Now you can see, compare your thoughts now. What is the maturity of this bond? 3 years. The duration is 2.653. It is less than 3, but it will close. 2.653. Right. Now I am asking you to do a small exercise. Now you change the say coupon payment for this. Now here the coupon payment is 10% no per annum. You take the coupon payment as 8%, and see what will happen to the duration. Right? Coupon payment is 8%. If coupon payment is 8%, the cash flow would be in the first year, in the first half year, it is only 4. Right? So you just do it and see what is the same way. So this is a type of exercise. Now you all should replace the coupon payment. Only change the coupon payment of this and do the calculation again. Every other things are remain same. Every other things remain same. But what you need to do is you need to change only the coupon payment. Coupon payment you have changed to 8% rather than 10%. So therefore the cash flow will become 444, and then last cash flow would be 104. Then the total would be 2, 3, 4, 5, 125. Sorry, 125. 4, 4, 4, 4, 4. 124. Just do the calculation and see what will be the present values. I will do it on the board. You get 3.767 for the first one. 3.767. $3.548. bonds price should come as 89.326. Now you all should do this calculation by replacing the coupon payment. Coupon payment should be taken as 8%, and do the calculations again. And if with that calculation, the present values you should get in the 0.5 time. When the time is 0.5, the present value would be 3.767. When the time is 1, the present value will be 3.548. When the time is 1.5, the present value will be 3.341. When the time is 2, the present value will be 3.147. When the time is 2.5, the present value will be 2.963. When the time is 3, that is the last date, the present value will be 72.56. You all got it? Got the values? And the total price, 89.326. Right. If you have done it correctly, you should get that answer. Right. Now the next column, that is the weight column. What we need to do is we need to get the weights. Now in the first one, you get 3.767 divided by 89.326. Now you do all the things and see whether the total comes to 1. Right. Since the time is now 3 o'clock, so I will give you a break and we will start by 3:50. Today you had a examination paper, no, in the morning. How was the paper? Huh? Paper was good, no? Yeah. 999, what you can do? Some adjustment in some place. Yes. Yeah. Okay, it's okay for 999. But what you can do is just make it 1 by doing the small adjustment somewhere. You got these weights? What is the first one? Oh, wait. 0.04. Next one.
0.040. 0.037. 0.035. 0.034. 0.81.
The total comes to 812. 1. Okay. Now we have the weights and we have the time the other side. So time 0.5, 1, 1.5, 2, 2.5, 6. Right. You do the total and multiplications. This one, what is the multiplication?
0.01.
0.012.
Sorry, 0.02.
1. Yes.
0.04. 0.056. 0.07. 0.085. 0.436.
Right, with the total, what is the value?
2.717.
2.71.
707.
Right. Now just look at it. Now I am just talking to the people also who are in the class. Right. Now, since the calculations are made, now we got this weights calculated and weight into the time, and we calculated the last column also. As per the last column, the total we got 2.707. So that means the duration of this bond has become 2.707, whereas the earlier bond's duration is only 2.653 something. Now you see, when the coupon payment is 10%, you had a duration of 2.653. When the coupon payment is 8%, you have a duration of 2.7. So that means lower the coupon payment, higher the duration. Lower the coupon payment, higher the duration. I think that really tallies with our concept also, because the duration is the time period where the total investment is paid back. Now, when the coupon payment is low, it takes a longer time to pay the total investment. That is the reason. Therefore, this really tallies with the fundamental concept. Anything else you need to clarify here? Yeah, you can. You can apply. Yes. Yes. So apply in the sense now here the value called duration we have calculated, and the earlier equations we talked about. No. Now that equation shows the relationship between the yield and the price. Duration is the connecting portion. So we will see that. Right. Now, in the earlier slide, we talked about the equation. Now, if you look at this equation, this one, delta P over P is equal to minus D into delta Y. This can be rearranged to show that delta P is equal to minus D into delta Y into P. Is that okay? Because it's a cross multiplication. So you can rearrange this equation number 1 to read as this way. Delta P is equal to minus D into delta Y into. This is a very important equation in this duration measure. Now it shows the price change for a particular change of yield, and we need to look at the duration measure and the change of interest rate and the price. Now I think this slide show also there's an exercise. Right, now you look at this. Using the equation, now this is the equation. Now the price of the bond is 94.213 as per the earlier one, not that later one. Earlier one it was 94.213 and its duration is 2.653 and delta y. Okay, now I am just asking this. Say there's a 1% change in interest, 1% increase in interest. What would be the price change? You can make use of that equation and do that. What is the change in price? If there's a 1% interest rate increase, 1%. Yes. Yeah, 249.95 is the coefficient there, but delta y is what? You have to multiply, no? With the interest rate change, you have to multiply. Delta y, you have to, in place of delta y, you have to put 0.01 or something, no? So then you get the answer minus 259.95 into 0.01. So that comes to 2.4995 minus 2.4995. And when delta y is 0.01. Now rather, now we just say delta P over P is this. Oh, sorry, delta P. Delta P is this. Now this is 2.4995 minus. Then what is the new price of the bond? 94.213 minus 2.4995. That is the new price of the bond after the interest rate change of 1%. And there's another thing I want to tell you. Now these interest rate changes are normally given in basis points. Rather than telling it as 1%, 2% or so, but we normally call it as 100 basis points. 1% change is given as a 100 basis point change. 2% change is given as 200 basis point change. 0.5% change is given as 50 basis point change. 0.25% change has given as 25 basis point change. Now you can now gather, no? What do you mean by basis point? Since the percentage terms, those are little cumbersome, so we give it by basis points. Basis point is equivalent to a 0.01%. 0.01% is equal to 1 basis point. 0.01% is equal to 1 basis point. So that is the conversion. So 0.25% is 25 basis points. Now here what happens is there's a 100 basis point increase in the interest rate. That way also we can put it. With the 100 basis point increase in the interest rate, the bond price has come down by 2.4995. Therefore, the new price would be 94.213 minus 2.4995. So that is how the calculation is made. Now there's another thing which we need to understand. Now in this macular duration calculation, what we did was, here you have a curve and we did delta P over delta Y calculation. there we had an assumption. The assumption is, now you can just look at this curve. In that assumption, we assume this as a straight line. In reality, it is not a straight line. But our calculations, we have arrived at our calculation, the assumption that. But it will become a straight line when this change of yield is a smaller amount. If I put it as a smaller one, it comes like this. Then it is tending to a straight line. So smaller the interest rate change, it will closer to a straight line. If you have a higher change in interest rate, this will be more curved line. Then it goes away from a straight line. So that is the issue in this duration calculation. In order to do a particular modification, we have another measure called modified duration. Modified duration is the accurate duration divided by, it is in the slides. One plus y over m. What do you mean by that? Y is the annual yield, m is the frequency of interest payment per annum. Now that is how the modified duration is calculated. Accurate duration divided by 1 plus y over m. Y is the annual rate, annual yield. M is the frequency of interest payments per annum. Now, for example, if it is half yearly one, M is equal to 2. Half yearly ones, annually there are 2 payments now. The frequency is 2 in that case. If it is a quarterly one, it is 4. If it is a monthly one, it is 12. That is how it is. So now, can you calculate the modified duration of this? There's no big difference, but there's a small difference. Because 1 plus y over m is very much close to 1. Because of that, the modified duration and the macular duration does not have a big difference. You make use of the first calculations data here. There the macular duration is 2.653. Then divided by what? 1 plus y. 12%. What is the answer? 2.503? Right. 2.503 because you get it as 2.5028. Therefore, you can put it as 2.503. So what you did was 2.653 divided by 1.06. Because 0.12 divided by 2. Now I will come to this slide later because there are several other duration related measures here. A thing called DV01, dollar duration and all that. Anyway, we will come to that later. And there's another concept. Now, before going into that concept, I will tell you now when the interest rate change is higher. Say, for example, if it is a 3% interest rate change, 300 basis points. Such changes, when there's a bigger change happens, the duration values may not be valid because it won't give a correct measure. Because our assumption is interest rate difference is a very small one. For that only, this will become a straight line, and then our assumptions hold true for that. Here, now there's a big curvature here. Now, because of this curvature, the values we determine may not be correct when this assumption is not true. What is our assumption? Delta y is a small amount, tiny amount or small amount. For a tiny delta y only, we have a straight line here. But if you have a higher change of interest rate, higher in the sense now, there's no hard and fast rule to say what is higher, but in my opinion, it is more than 150 basis points, 1.5%. Then we can consider it as a substantial interest rate. For substantial interest rate, duration measure will not be or may not be accurate. Then there should be an adjustment made. Because that adjustment is necessary because the curvature of the curve. The duration measure is made in the assumption that interest rate difference is small. Why we have that assumption? Now don't we have a straight line there? If the interest rate change is so high, then it is not a straight line. It will become a curve. Then since our assumptions are not true, our results also will be not. So then there's an interest rate change higher than 1.5%. Then we have to have an adjustment for it. Make it the accurate. For that, we need to calculate another concept, another value called convexity. We call that adjustment convexity adjustment. Duration and convexity are two measures. If I put it in physical form, convexity is a measure to look at the sharpness of the curvature. If convexity is higher, sharpness of the curvature is higher. Now, I will show you two curves and you can gather what I am telling now. Now this is curve number 1, curve number 2. Which curve has the higher curvature? Number 1 or number 2? Higher curvature. Number 1 is more curve. Second one is also curve, but not as sharp as earlier. The second one is more close to a straight than the first. So convexity is higher in the case of number 1. Convexity is lower in the case of number 2. The convexity is low the adjustment is a very small amount. Therefore, the duration measure is negative. If the convexity is higher, if the curvature is higher, the convexity will become a higher figure. Hence, the duration measure may not be good. In order to put it into the correct form, you have to do the convexity adjustment. So, in order to do that, we have to find out what is convexity. We have to find out the so-called convexity. Convexity is nothing other than, it's easy, nothing other than time squared weight of the total gas. So, time squared weight of the gas. Now I will show it in the next slide. In the next slide, you can see that. Here, modified duration may not predict the rate sensitivity in a reliable manner for higher level of interest rate variations. Duration measure assumes the relationship between price and yield is as linear, as the relevant interest rate changes are minimum. Now, this is the assumption we have. Now, this assumption will not be true when the interest rates are, differences are very high. When a substantial change in interest rate is present, the curvature of the price yield curve matters. Then the price change should have the convexity adjustment. Convexity is the time squared weighted present value of expected cash flows of a bond. I will show you how to calculate convexity. Right. So what you need to do is, you need to add another column into this. Another column into this. You should have a column called time squared here. Somewhere here, time squared. So time squared would be now, what is the square of 0.5? 0.25. 1 is 1. 1.5, 2.25. 2, 4. 2.5, 6.25. 3, 9. Those are the time squared. That is what you call the time square column. In the time square column, you have these values. 0.25, 1, 2.25, 4, 6.25, 9. Those are the values coming under time squared column. You can add that column in between these two. Time squared. And you have to add another column here. We call it time squared into 8. Time squared into 8. That means you multiply the time squared column value with the weight column value. In that occasion, now you have to have 0.25 into 0.050. Then you get the time squared value here. You add that column there, and you will arrive at the convexity also. Time squared into 8. First one would be 0.125, is it? 0.125 or yeah. Then you get 0.047. Then you get 0.099. And what is the convexity then total? You got the value for the duration? Seven 7.576. Wait, I will. Okay. Seven 7.5722. Okay, that's okay. 7.572225, I got it. 7.5723 in that case. So, oh, it's okay. No issue. 7.57 up to 7.57, it's okay. That is the convexity. We call it the convexity of the bond. 7.57. That is a simple game because very straightforward things are there. No confusions. Just to add the very routine type of exercise. What you need to do is you need to have the time column squared. Then it is to be multiplied with the weight column. The total of the time squared into weight column is will give the convexity. Convexity. The meaning is the convexity is so high, 7.57, and if you calculate it to the duration, compare it with the duration is only 2.653, whereas the convexity is 7 point something. So that means the curvature is high. Curvature is high, and we may not be in a position to rely on duration measure for a long, bigger interest rate changes. That is the meaning we get from this. If the convexity came as a lower figure, we don't need to worry about the duration. Duration measure will be accurate. Benchmark. Yeah. The norm is actually it is not a norm really. It's a rule of thumb or something like that. Now it's like this. If you have a convexity which is say similar to the value of duration, then it doesn't matter. Now it says here, in order to arrive at more reliable projections, convexity adjustments also to be included. Hence, if the bond value changes for a higher interest rate variation to be determined, it is advisable to apply following equation. Now we can have an equation for that also. This is the equation. Now you can remember we discussed about the equation at the beginning. At the first slide, second slide we just had this equation, but without this portion. Without this portion, we had the equation. Delta P over P is equal to minus D into delta Y. So that equation we discussed. But there you didn't find this half into C into delta Y square. It was not there. This is what we call the convexity adjustment. Now D is the duration, C is the convexity, delta Y is the change in yield, delta P is the change in price. Now I will show you a small rearrangement here, because that could be more simple for you rather than putting it this way. Now you can remember that we had a equation like this. Delta P over P is equal to minus D into delta Y. This was the equation we discussed earlier. Now with the new invention, that is delta P over P is equal to minus D into delta Y plus half into C into delta Y. Right here, C is the convexity, D is the duration. Now, in order to have a simpler form, we will do this. Delta P is equal to minus D into delta Y into P. P comes C plus half into C into delta Y squared into. This is the equation you can apply. Because you have to multiply this with P. It's also to be multiplied with P. It's a cross multiplication. Cross multiplication. Right. Now you might wonder what is it? Actually, this is a mathematical formula. We call it the Taylor series. Taylor series. There's a mathematical series called Taylor series. We call it the series of derivatives. Derivatives is not the financial derivatives, they are mathematical derivatives. Differentiation. Have you heard about differentiation in mathematics? So those are the derivatives in mathematics. Now, there are a series defined with derivatives. That series is called the Taylor series. Now, Taylor series approximately call it a Taylor series approximation. Now, Taylor series approximation. Now, this is the first order approximation. This is the second order approximation, and it will be continued with power 3, power 4, power 5, and so on. We have taken only up to this. But when you talk in terms of duration, we have taken only this particular point. These things have not been taken into consideration. But in order to have a better accuracy, we have to consider these also. That is the background behind it. You might wonder why. Right. So now you will see how we can use these things in our analysis and all, our decision making. Okay, we will just do an exercise. Right. Now we will see if the interest rate change is 3%, say 300 basis points interest rate change. You calculate the price change of the bond. Now you can't now just satisfy with the duration calculations. You need to calculate the convexity and do the adjustment. Otherwise, you would not get accurate answer. So therefore, what you need to do now is you need to apply this equation. You need to apply this equation. So apply it, because now you have already calculated the duration and the convexity both. Therefore, now you just see for a change of 3% of interest rate, what is the price change of the bond? What are you going to do now? We already calculated, that is 2.653 into delta y. Delta y is what? 0.03, because it's 3%, into P. P is the price of the bond, 94 point something, no? Price, plus half into C. C already calculated 7.57 or something, no? 7.57 into delta y squared, that is 0.03 squared, into the price. Or otherwise, what you can do is just keep out the price from this. Later, you do the calculations without taking the price into consideration, and you multiply price at the later stage. That also can be done. Duration was 7.57, no? Sorry, convexity was 7.57, no? Now you got the value as minus 0.07618. That is now without multiplying with the price, just the other one. Minus 0.07618. Now what we need to do is this. But let's see. 94.213, no? The price. Minus 7.177. Correct. Right. Is it clear for you, others? So what we need to do is we can take out we did, because otherwise now this will become more cumbersome. No? So what I did was I just take only these things, and then later on I calculated this, and later on I multiplied it with P at last. Yeah, that also can be done. That also can be done. Now, if I put the calculation in black and white, it comes like this. Delta y is 0.03. P is 94.213. Plus. Now this is a minus one. Now. Half into 7.57 into 0.03 squared into 94.213. At last, you should get this value 7.177. That is minus. Delta B is equal to minus 7.177. Then you can apply it with the bonds value, that is 94.213. Then the new price would be 94.213 minus 7.17. Now we go to another concept. We call it the portfolio duration. Now, what is a portfolio? Portfolio means now you may have number of bonds in them. Treasury bonds, number of treasury bonds, number of treasury bills or whatever. So in a portfolio, you have a number of assets. Even a loan portfolio, if you take a loan portfolio, there you have several loans. Now in your bank, you have a housing loan portfolio. There can be thousands of loans there. And sometimes you have a SME loan portfolio. There you may have thousands of loans. So likewise, if you take a bond portfolio, there you have several, even sometimes thousands of bonds are there. So what is the concept called portfolio duration? Portfolio duration means you need to look at each bond which is in the portfolio, the duration of each bond. And you have to see the value of the bond and its weight in the portfolio. For example, say, now I have taken into consideration two bonds in the portfolio. Now that this is a very simple portfolio where you have only two bonds. One bond's value is say 100. The other bond's value is 200. So then what is the weight? One bond is 1/3 of the weight. The other bond is 2/3 of the weight. The total portfolio. So if you have calculated the duration of these two bonds, say 100 value bonds duration is 2. 200 value bonds duration is 3. Then we can find out the portfolio. How do we do that? We have to get the weights. The first bond's weight is 1/3. Second bond's weight is 2/3. Then we have to multiply the weight with the respective duration. So 1/3 into first bond's duration, I told it is 2, no? Then 1/3 divided 1/3 into 2 plus 2/3 into 3. The total will give you the portfolio. It's a very simple calculation. Just like weighted average or weighted average, the same weighted average concept is there. You need to get the weights, you need to get the separate durations. And what you do is, you multiply the weight with each duration. The total will give you the portfolio duration. Convexity also the same. If you know the convexity of one bond, each bond, you will have the convexity of the portfolio in the same way. So weighted way you get. Right, now before going into these strategies, we will see some examples of portfolio duration and the convexities. Right, I will put on a certain example here. This is the exercise. A portfolio consists of 3 bonds with following values and durations. There are 3 bonds. First one's value is 1 million and duration is 2.5. Second one's value is 1.5 million, the duration is 3. Third one's value is 2 million, duration is 4. So, first of all, you need to calculate the portfolio duration. Then, you need to calculate if there's an interest rate increase of 100 basis points, what could be the new value of the portfolio? The new value can be calculated through after having the portfolio duration calculated. What is the portfolio duration? Simple. Weighted average you have to have. What you have to do is you have to multiply the duration with each value. 1 into 2.5, 1.5 into 3, 2 into 4, divided by total of the bonds. So same thing, no? When you get the weights order, you do the same thing. Then what is the answer? Total value is 4.5, no? Total bond value is 4.5. $3.33, yes. That is the portfolio duration. Now, when the portfolio duration is gone for a 1% interest rate, that would be the portfolio value. Now, what we need to do is you just calculate the. Now, first calculation is portfolio duration. After getting the portfolio duration, need to apply the equation delta P is equal to minus D into delta Y into P. And what you can do is you can apply the portfolio value there, duration there, and the interest rate change. Then by multiplying the things, you will get the price change. 1%. Yeah. See, 0.01. Now, if you put it in decimal form, it is 0.01. So then what is the price change? I have calculated it in millions. Price change is 0.15 million. I don't know. Minus 0.15. Is that correct? Minus 0.15. So the portfolio total value is 4.5 million. Therefore, the new portfolio value would be 4.5 million minus 0.15. 4.35. It will come to 4.35 million after the value drop. There's a loss of 150,000. 0.15 million is 150,000, no? Is it? 0.15 million? Maybe 150,000, yes. Now, I think for your interest, you can just talk with your bank's treasury dealers and all. You can get a good idea about these things. They always, I mean, they daily do these type of things, this type of operations. And they are very much thorough with these things. And you can get some knowledge from them also. If you have friends there, you can talk to them. Right. Now say, if I just ask you to calculate the new portfolio value for a 300 basis point change in the interest rates, what do you say? Can you do that? Since it is 300 basis points, it's a very huge interest rate change. So therefore, we cannot rely on duration measure for such type of calculations. Then we have to get the convexity adjustment into the calculations. So then we need to have convexity also here. If we have convexity with this particular data, we would be able to calculate for a 300 basis point change also the portfolio value. So then I will give you the convexity values also there. So then you will be in the position to do that calculation also. But in an examination question, if you get this type of a thing and ask for a 300 basis point change of interest rate calculation, then the convexity is not given there. So you should say that since the interest rate change is very high, the values calculated here will not be accurate. And to get more accuracy, we need to apply the convexity adjustment. But in this particular sum, the convexity data has not been given. Therefore, but we have given this answer with some limitations. The limitation is this. So you have to put that way. Then you will get the full marks if you put that. But if you just calculate the things without taking into consideration anything, you will not get any marks. What I want to tell you is the calculation is not really worthwhile. You have to get the meaning of it. And you have to apply the fundamentals. That is the thing. Because it's like this, no? Now you are in decision making positions. Now your decisions depend on what you have learned. So if you have learned it in the correct way and with the correct fundamentals, it is very easy for you to take decisions, and you will be confident about your decisions if you do that in that way. Otherwise, most of the people do in a very routinized manner, just like a machine. So you should not do that, because they go through a prescription. That is what they do. But those things are not really worthwhile. Now, as analyst, you have to be very much, very much clear in your thinking, and you have to follow the fundamentals and principles. And you can really think very innovative type of ideas. You can get very innovative ideas by doing that. Very novel ideas you might get. Right. Now there are two strategies I have just put here. Now, barbell strategy, mix of long and short-term maturities in the portfolio. So that is what now normally in a portfolio, as a portfolio manager, you need to see how you can get a good mix of bonds. Now, how do you do it? If you have a mix of long and short-term bonds in the portfolio, say for example, now you have 2-year bonds. That's all. Sometimes you might have 10-year mix. Then by doing that, what you are going to achieve? By doing that, by having a mix of longer and shorter term bonds in your portfolio, what do you need to achieve? What is your intention? Now, when you say maturities, the maturities are really connected to the durations. If you have higher maturity bonds, then higher durations. Now, for example, now if you have a 10-year bond, duration is close to 10. If you have a 2-year bond, duration is close to 2 years. So then if you want to get the portfolio duration, then the mix will bring down the portfolio duration. So if you have only 10-year bonds, then the duration will be 10. But if you have 10-year bonds, 5-year bonds, 2-year, 3-year bonds, then your duration will come down. The portfolio duration. It might come down to 4 or 5 or something. Now, even now, your portfolio duration is only 4, but you have 10-year duration bonds there. But it doesn't matter, because it really behaves as a portfolio. Then the portfolio duration is only 4. It behaves in that manner. So that is the strategy, the barbell strategy. So you have a mix of longer and shorter term bonds. Mix. Your ultimate intention is to have a moderately low duration portfolio. Why do you have a low duration? Because your risk is low in the low duration portfolio. Because for an interest rate change, the value drop would be lower. Higher the duration, higher the value drop. That is the issue. Then there's another thing called bullet strategy. Bullet. A portfolio with bonds of intermediate maturities. All the bonds are in intermediate maturity, 2-3 year type of maturities. So then ultimately it's a lower duration portfolio. And there's another concept, portfolio immunization. I think these days you have to talk in terms of immunization of COVID and all sort of things. Immunity. You have to develop immunity among the general public in order to prevent from COVID or whatever. So the portfolio immunization is also now, in order to avoid interest rate risk, you need to do portfolio immunization. Just see what do you mean by portfolio immunization. When a portfolio consists of long and short positions in interest rate dependent assets, it can be protected against small parallel shift in the yield curve by ensuring that its duration is zero. Now, if you want to have a portfolio with a zero duration, whatever the interest rate fluctuations in the market, it won't affect the portfolio. The total portfolio's duration is zero. So that is what you call immunization. You need to do some manipulations and bring the portfolio duration to zero. That is what you call portfolio. Yeah, that's the thing. Now, yeah, what we do is now you need to, when you say duration, the duration is positive for an investment. When you invest in a bond, investment. And you remember that we talked about leverage portfolio. Leverage portfolio, can you remember? The capital market time. You have the market portfolio at a particular point. From that point, if the capital market line being divided into two, one portion is called the lending portfolio, the other portion is called the leverage. Now, in leverage portfolio, what happens? You have borrowed. A borrowing is taken as a negative investment. Borrowing is taken as a negative investment. Now, if you talk in terms of liabilities over in a portfolio, the duration of a borrowing is negative. That is how we can mix borrowings and investments in one portfolio. That portfolio duration will become. So that is how the immunization can be made. Yeah. Because you have liabilities also there, not only assets. Not only assets. I will give an example. Now I need to know your names since you have come physically. So I just want to see whether there have been several people who ask questions and who send some messages and all. I wanted to see that one of you there. Have you? I can remember there were several persons because I really appreciate that. But otherwise now these things are very boring and also get go. I do the exam. But having an interaction that could really help. Not only the lecture, all of you will get the real benefit. That would be Right now, I will show you a certain example of this nature. Now, there are companies now, they need to have their pension funds. So they need to pay pensions for their employees. So what they do is they build up a fund. They call the pension fund. So I will give an example of that nature, and I will show you how we can have the portfolio immunization. Right. Now, pension funds, they need to have 20 million payment for a pension fund. So those are like investment. So those are like borrowing because they have just those are liabilities. Those are liabilities created. So since the liabilities are being created that way, they can immunize it through some investments. They have to invest in some bonds, 3-year and 2-year bonds. So by doing the investment, now they need to see how much of 2-year bonds and 3-year bonds. Yeah. That is how the immunization is. So I will show you how it happens. So right, I will put it on the board. Now these payments are made for 4 years. Suppose that a corporation wants to make annual payments of $20 million to make up its pension fund. in order to immunize the portfolio, they need to invest in 2-year and 5-year zero coupon bonds. Now, what we need to do is we need to understand how we can make it an immunized portfolio. What percent should the corporation allocate to 5-year and 2-year bonds? Right. Now, this is a situation a corporation has to face. Even a bank may face this type of situation because banks are very much burdened with their pension payments. Very much burdened. I know with Bank of Ceylon, actually, they have billions of money in the pension fund. Billions. Right. What we need to do here is, since the payments are being made, $20 million payments are being made each year. So first year 20 million, second year 20 million, third year 20 million, and fourth year also 20 million. So now what we are now going to do is, we are now trying to see the duration of those payments. Now, likewise, now say when we calculate the bond duration, what we do? We just go by its cash flows, present value of its cash flows. In the same manner, we can go by the present value of these pension cash flows, pension fund cash flows. So how are we going to do it? Here, cash flow, present value. Right, that way we can do 1, 2, 3. Cash flow is 20. But unlike in the bond, it is same cash flow every time. What is the present value? Now assume the market rate, market interest rate as 11%, because that gives you the possibility of discount. Yes. So tell me the present value of this 20 cash flow. 20 divided by 1.11 is the present value of that cash flow. What is the second one? 20 divided by 1.11 to the power 2. No. Here we do the normal what you say. The power is also. But here it would be difficult to do that. It's not wrong, right? You can do that. But here what we do is we just go by the normal compound. Because these are normal cash flows. Therefore, we go by normal compound. But yeah, it is not necessary to go for this because there are no awkward type of guidelines. Just 1, 2, 3, 4. So therefore, it is more easy to do the normal compounding. Then here you get 20 divided by 1.11 to the power 2, 20 divided by 1.11 to the power 3, 20 divided by 1.11 to the power 4. You should get the values. What are the values? 20 divided by 1.11 is 18.02, is that? 20 divided by 1.11. 18.02. 18.02. Then you get 16.23. Then you get 14.62. Then you get 13.17. And if you get a total of it, that gives the percent value of total cash flows. That is 62.04. Now, in order to get the duration calculated, what you should do? You should multiply. Now, rather than going for weight, what we can do is 1 into 18.6, 2 into 16.2, 3 into 14.62, 4 into 13.17, divided by 62.0. Right? So that same thing happens. Now, otherwise, what you do is you just calculate the weights. No, when you calculate the weights, what you have done? You 18.02 divided by this, 16.23 divided by this. No, that's not. That's how you did the weights calculated. But here, what you can do is you just multiply here with the PV, here with the PV, and add up, and the whole thing to be divided by total value, that is 62.0. Get the same answer. Get the answer for that. Now, what we have now done was we have gone through the cash flows where we had 20, 20, 20, 20. Those are for 4 years. And for each year, we calculated the present value. In the first year, the present value is 18.02. In the second year, it will be 16.23. The third year, it would be 14.62. In the fourth year, 13.17. The total comes to 62.04. Now, in our duration calculation, what we need to do is you have to multiply 1 with 18.02, 2 with 16.23, 3 with 14.62, and 4 with 13.17. And the whole thing to be divided by 62.04. What is the duration? What? Yeah, 2.37. That is the duration. 2.37 would be the duration. MD is equal to 2.37. MD is macular duration, right? Macular duration is equal to 2.37. Now the duration is measured in what terms? Duration is measured in what terms? What is unit of duration? Yes. What is unit of duration? Yeah. In what year? Yeah. Yes. 2.37 years. Even though the cash flows been studied for 4 years. Yeah, we have dealt with the cash flows of 4 years. Even though it is 4 years, the real duration is only 2.37. But why it is happening like that? Because the cash flows are there. Now the cash flow, we have got cash flows for each year for the 4-year period. Because of that, our duration is very less than 4 years. No, it is not minus. this particular case, now we have taken it separately, not in the portfolio. So therefore, it is not a minus because this is an investment for them. Whatever it is. Now it's like a sinking fund. They are having a sinking fund. So they just put money to the sinking fund. So in one way, we can put it as an investment also. So therefore, if you take it singly as a particular investment, we can take it as it. Then no need of putting it in minus form. Then now what we need to do is we need to have, in order to immunize this, we will now this is a type of payment we are going to make. It is an outflow line. But through our investment, we will have an investment in the 2-year and 5-year bonds. Now, when we say 2-year and 5-year bonds, can you tell me what are the durations of these? Since those bonds are zero coupon bonds, tell me the duration of 2-year bond. What is the duration? 2 years. What is the duration of a 5-year bond? 5 years. Since those bonds are zero coupon, their durations are also the same as their maturities. Then just assume the value of 2-year bonds as X, right? That is our way. Assume the value of zero coupon bonds as X, or the weight, not the value, weight of. There are only two 2-year bonds and 5-year bonds. So we assume the weight of 2-year bonds as X. Then what would be the weight of 5-year bonds? 1 minus X. 1 minus X. Weight of 2-year bonds as X. Therefore, the weight of 1-year bonds, 1 minus X. Now you have the duration and for each the weights. Then duration into weight. So then that would be the portfolio duration. Now, if you want to apply that minus there, then now we can do that, right? So what we can do is this. 2x. That is the now X is the value weight of 2-year bonds. And what is the duration of that one? 2. Therefore, duration into weight would be 2x. Are you okay with 2x? Plus, what is the other one? 5. 5 into 1 minus x. Now, if you want, you can put all these things as minus. Those are liability creating things. And that is an investment. No, sorry, this is an investment. So therefore, those are pluses. And the other one, what is the duration of that one? 2.37. It's a minus duration, as I told you earlier, because it's a liability. 0.37. Since they form an immunized portfolio, the total duration will be 0. Then we can put it as equal to 0. Right? And 2x plus 5 into 1 minus x is equal to 2.37. Now you can solve it for x. Just get x. You can solve it for x. Right. Have you got value for x? What is that? 0.876. Yes. 0.876. You can take it to 2 decimals. So then you can put it as 0.88. That's correct. 0.88. So then when x is 0.88, 1 minus x is 0.1. Then so therefore you have to purchase 88% of 2-year bonds, right? 12% of 5-year bonds. 88% of 2-year bonds, 12% of 88% of 2-year bonds, no? Yeah. Yeah, 2-year bonds. Because we assumed x as the rate of 2-year bonds, no? Therefore x is since x is 0.88, we have 88% of 2-year bonds and 12% of 5-year bonds in the book. And we have to find out the face value. How are we going to find the face value of these bonds? Now, can you calculate the present value of these bonds? Now, what is the total value? 62.04. So, 88% of 62.04 would be the percent of consists of 88% 2-year bonds as we calculated. So, therefore, the present value of 3-year bonds would be 88% of 62.0. 62.0. PV of 2-year bonds equal to 88% or 0.88 into 62.04. What is the value there? What is the value there? 0.88 into 62.04. 54.6. Is that? 54.6. The rest of that could be 5-year bonds. So that is 62.04 minus 54.6. That also can be done. Or even you can calculate it. 7.44. PV of 5-year bonds. 7.24 is it? 44. 7.4. You can either get the 12%, 0.12 into 62.4, or you can deduct 54.6 from 62.04, then you get 7.4. 7.4. Now, how are we going to get the face value? The yield has been given, no? 11%. Then for 2-year bond, what would be the face value? This is the present value. The future value you have to get. How do we get the face value? 1.11 to the power 2. So you have to multiply 54.6 with 1.11 to the power 2. 1.11 to the power 2. The other one? What is the face value then? Six, 67.27. Right. So that is the face value for 2-year bonds. The 5-year bonds, 12.5. Yes, 12.5. Yes. Now I just want to deliver that this concept. Yes. It is close to 80, no? Is it? Wait. Yeah. Yes, yes. You get 79 point something, no? And 5-year bonds face value. Yeah, that is 7.44, no? Yeah, face value 7.44 into 1.11 to the power 5. To the power 5. To the power 5. Because it will be maturing in 5 years, no? Therefore, the future value we have to get 1.11 to the power 5. I think you have asked a good question. I mean, the total to be tallied with 80. But it is not. I think we have done some rounding of something. Because of that, it doesn't come to exact 80, but yeah. Yeah. That also can be done. But in order to have this 88 calculated, we have to do this. Otherwise, we can't calculate the percentage. Percentage is calculated through the equation. The immunization concept we have used. Yeah. Without written that we can do that. Right. Anyway, I think now for different types of investments also we can make use of this type of immunization concept. Ultimately, the concept is this: put the total to a zero duration type of a thing in order to immunize the things with interest rate fluctuation. So interest rate fluctuation is the virus. So you can immunize the portfolio from that virus by letting it have a zero. That is what the concept. I think you got it correct, the immunization process. Right. With that, we can wind up today. Because I thank you all of you to stay here. I know that this is a real harassment for you all, because after doing an examination, the mood is not there to stay for a lecture. But you have done a great thing. Just notwithstanding that you did an exam, you just waited for this.